As of right now, the stock market is closed for the weekend, and looking back at the most recent trading session ending on Friday, July 3, 2026, Navitas Semiconductor, trading under the ticker symbol NVTS on the Nasdaq, finished the day at a closing price of $14.46. This represents a massive, staggering drop of 12.52% in a single day, with the stock price shedding $2.07 from its previous close of $16.53. The trading volume was exceptionally high, breaching 29 million shares, which is significantly elevated compared to its recent multi-week average. For anyone tracking this asset through an individual brokerage account or an online investment platform, this sharp downside movement feels like a severe blow. But the immediate insight that most retail participants are completely missing right now is that this collapse is not merely a symptom of macro-level technology sector cooling. It is the direct consequence of an aggressive corporate capital preservation strategy meeting an ill-timed sector-wide reassessment of artificial intelligence infrastructure spending. Specifically, recent regulatory filings have exposed a massive $125 million at-the-market stock offering program, coupled with the sudden distribution of more than 6.5 million additional shares linked to historical corporate earnout agreements. When a small-cap chip developer floods the market with that level of equity dilution, the near-term supply-demand balance for the stock breaks entirely, forcing institutional desks to aggressively reprice the equity, regardless of the underlying technology promises. This brings us to the profound friction between market expectation and cold corporate reality that defines the current state of online investing for specialized chip companies. The common ground among retail investors utilizing platforms like the Robinhood app, SoFi Invest, or checking metrics across various popular investing sites has been an overwhelming optimism regarding alternative semiconductor materials. The prevailing expectation was that Navitas would act as a high-growth vehicle riding the coattails of major data center build-outs, perhaps mirroring the explosive historical trajectories seen in names like NVIDIA stock, Apple stock, or Tesla stock during their peak expansion periods. Investors assumed that because high-power computing infrastructure requires advanced power management, a specialized company focused entirely on next-generation efficiency would see an immediate, uninterrupted ramp in corporate procurement. This structural optimism caused a massive speculative rally earlier in the year, pushing the stock up over 100% from its spring lows as self-investing accounts accumulated shares based on rumors of enterprise design wins. However, the underlying reality revealed in recent financial statements presents a fundamentally different picture. The corporate reality is that Navitas reported first-quarter revenue of just $8.6 million, which represents a steep decline from the $14 million recorded in the same period of the previous year. This revenue contraction, combined with persistent operating losses, means the business is burning cash to sustain its research and fabrication pipelines, necessitating the very equity dilution that triggered this massive weekly sell-off. When you analyze the trading architecture of this stock through a high-tier platform like Interactive Brokers Trading, you can clearly observe how institutional distribution patterns began shifting long before the general public caught on to the dilution risks. Large-scale asset managers using automated portfolio algorithms or allocating through institutional services at Fidelity Investments started scaling back their exposure as soon as the at-the-market equity program was finalized. The fundamental structural challenge with small-cap semiconductor design companies is that their capital expenditure requirements remain stubbornly fixed, while their revenue conversion cycles are highly erratic and dependent on massive multi-year enterprise qualification processes. Retail traders looking at simple charts via basic Robinhood stock trading features often mistake a major technical partnership announcement for immediate revenue, whereas sophisticated entities utilizing interactive brokers' fees models and advanced options tracking see that commercial scaling often lags technical development by 18 to 24 months. This lag creates a dangerous vacuum where the company must consistently fund its ongoing operations by tapping equity markets, creating a structural drag on the share price that prevents it from sustaining long-term breakouts. The macroeconomic pressures currently sweeping across the broader technology landscape have amplified these internal balance sheet vulnerabilities. When you scan the semiconductor sector using a comprehensive tool like the Fidelity mobile app or monitor specialized Fidelity ETFs, you notice that the entire hardware space has experienced sharp corrections over the past few days. The catalyst for this broader decline stems from a growing institutional concern that major hyperscalers are actively searching for ways to optimize their internal processing configurations and extract maximum performance from existing hardware assets, rather than continuously expanding their physical footprint at an exponential rate. Furthermore, recent market updates indicating that major technology conglomerates are successfully improving the software-level efficiency of their computing models have caused analysts to question whether the near-term demand for advanced power management components might flatten out over the next few quarters. For a massive titan with billions in free cash flow, a temporary plateau in infrastructure demand is a minor speed bump, but for an emerging player like NVTS, it threatens the timeline required to achieve operational profitability. This structural shift has caused a rapid reallocation of capital away from speculative small-cap hardware plays and back towards established large-cap entities, leaving self-investing participants who bought near the 52-week high of $34.17 exposed to severe downside volatility. To truly understand what this business does and why its structural narrative is so highly contested on modern investing sites, we have to look beneath the financial volatility at their primary technology focus. NVTS operates almost exclusively in the field of wide-band gap semiconductors, specializing in gallium nitride and silicon carbide power-integrated circuits. Traditional power management has long relied on standard silicon chemistry, which is rapidly approaching its inherent physical limitations regarding thermal conductivity, electrical breakdown fields, and switching speeds. Gallium nitride and silicon carbide allow power electronics to run significantly faster, tolerate substantially higher voltages, and operate at much cooler temperatures while vastly reducing energy waste during power conversion. In practical terms, this technology is highly sought after for consumer electronics fast chargers, renewable energy systems like solar inverters, automotive drivetrains for electric vehicles, and high-density power supply units inside modern server racks. The long-term investment thesis that bulls frequently discuss on the Fidelity trading platform is centered on the idea that as data centers transition to higher voltage architectures to support intensive computing clusters, the adoption of gallium nitride components will become non-negotiable to prevent catastrophic grid overloads and cooling failures. However, historical performance records highlight just how difficult it has been for NVTS to translate this technological superiority into stable financial metrics. The company entered the public markets via a special-purpose acquisition company merger, a structural mechanism that provided immediate capital but also saddled the organization with intense public market scrutiny and a highly volatile retail shareholder base. While early product launches in the mobile fast charging sector achieved decent volume, the margins in consumer electronics are notoriously thin and highly susceptible to intense pricing pressure from overseas competitors. As a result, management has had to aggressively pivot its strategy towards high-margin, capital-intensive industrial fields, such as automotive systems and enterprise data infrastructure. This transition requires significant research and development development outlays, long certification cycles with automotive manufacturers, and custom engineering collaborations that do not generate immediate commercial returns. Consequently, their quarterly cash flow statements have shown a persistent net drain, with operating cash flow consistently remaining in negative territory, forcing the company to carry a complex capital structure that relies heavily on continuous equity financing to preserve its net cash position. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio, or if you prefer sticking to large-cap technology stocks in this current market environment. Looking ahead towards the final months of 2026 and into early next year, the trajectory for this asset will be entirely determined by how reality resolves the current tension against investor expectations. There are two distinct structural scenarios that could unfold from this current $14 level. In the optimistic scenario, the aggressive capital raise via the at-the-market offering will provide the necessary financial runway for Navitas to finalize its high-voltage server power supply contracts with enterprise data center operators, leading to a massive inflection in high-margin revenue by the first half of 2027. If the company can prove to the street during its upcoming earnings calls that its product pipeline